There we go. I think it's now recording. So what we're gonna do is I'm gonna go through this, and hopefully I'm gonna go through it at a pretty quick clip. But if you have any questions, feel free to interrupt me, and I'd be glad to answer any of those. And then we're gonna kind of try to do a summary of grain markets with a little bit of a discussion around farm income for later in the fall on the back end. So again, my name's Ben Brown. For those of you who haven't met, I work in the Ag Econ department here on campus, doing grain markets and policy. And I want to first start off with just talking about this slide. I pulled this. I actually lifted this from the New York Times. This was a graph that they had put a couple weeks ago showing the change in consumer spending from 1 year prior. So this is just one data point, and obviously looking at one data point sometimes over exaggerates a story, but I found it kind of interesting because it was largely exactly what we thought. Right here in the middle is 0%, and then you can see, the increase in expenditures in the green, the decrease in expenditures in the red, and they've just highlighted a couple. And then the size of the circles represents the industry sales from the year prior. A couple of things that stood out to me a little bit is I was surprised to see supermarkets not larger further in the positive category than what they were. Some of that I'm wondering if it's not made up by online grocery shopping over here. That's where that's really picked up and pulled people further in that direction in that circle, given that the size of the circle represents a year prior, that size of that circle isn't bigger this year. But certainly some big changes in the industry, especially when we look at travel and lodging and how we consume food, but it really plays a lot into our gasoline consumption if we're not traveling and flying as much or using cruises, and we're certainly not moving around as much as what we have. And so this really feeds into our ethanol picture, which ethanol represents about 45% of our corn demand, anywhere between 45 and 40% of our corn demand here in the United States. So I've got two graphs here representing this is profitability of an Ohio ethanol plant, 100 million gallons produced per year. Just for perspective, the Poet plant in Marion is about 150. That's our largest. So this is smaller than the Marion one, but bigger than most of our others. So I just kind of use this as kind of the benchmark. The bars down here at the bottom, black bars mean profitable months. Red bars mean not profitable months, losing money. And you can see really since June of 2018, we've been consistently losing money in ethanol production. It's really tanked off here in March and April. I don't have the latest month, even though I do have that information. And that's largely been the drop of ethanol prices due to decreased gasoline consumption. Of course, ethanol is 10%, roughly 11% of every gallon of gasoline we consume. So if we're consuming less ethanol, we're consuming less gasoline, we're consuming less ethanol. And that's then started to translate into our ethanol production. And so this is now going back ethanol production weekly, all the way from January of 16, all the way through our latest week, which is the last week of April. That would be the last week we have data. And you can see what we've done. Back here in October of 19, this little downward peak right here, this is when we started really seeing a lot of trouble with our ethanol plants, and we started getting reports of ethanol plants closing. That was all the way back up here. We were producing somewhere around 940,000 barrels of ethanol a day. We recovered pretty nicely as corn prices dropped in the fall, as we had a bigger crop than what we expected. But you can see what we've done really since the start of the outbreak, decreased driving. We've just continued to suppress our gasoline production. We have not seen a week of recovery. Now, a positive is the last 2 weeks we've seen higher gasoline consumption. So we've had 2 weeks now of higher gasoline consumption, which signals that people are now starting to return back to driving. We're getting a little bit more mobility in our economy from that standpoint. But it's going to be a slow curve on the ethanol side because we've built up big ethanol stocks, and we'll have to continue to work those down. This drop is about 50% of our weekly production is about what we've lost. That translates to about 57 million bushels of corn per week. And as you can see, we're now 4 weeks basically here below 700,000 barrels of ethanol production a day. So that there in itself is 200 million bushels of lost corn demand. Plus then you've got some of this other stuff, and we start debating how quickly can we return. I just do want to make the point that low oil and low ethanol prices are not mutually exclusive. Traditionally, when we have low oil prices, we actually see a surge in ethanol consumption and therefore ethanol prices. So they tend to be, they tend to go in opposite directions of each other. And the theory behind that is when we have low oil prices, we have low gasoline prices, and therefore we drive more, or we consume more oil because it's cheaper for us to consume. However, again, this is kind of an interesting situation where we have low oil prices and we can't consume because we're, roughly about 2/3 of the world is in some form of stay-at-home order, limiting mobility, and I expect for us to stay in that for a little bit longer. Now, the interesting question is later in the summer, as some of these stay-at-home orders come off and we have low oil prices due to some of the politics globally with Saudi Arabia and Russia suppressing oil prices and ramping up production, do we see a surge in gasoline consumption with low gas prices? Do we see a surge in gas prices? Does that incentivize more ethanol production? Long story short is, I've got us right now at a loss of about annualized ethanol production of, corn used for ethanol at 675 million bushels of corn. The USDA lowered their ethanol production in the previous estimates by 370 million bushels. So I would argue there's about another 3 million bushels of corn that has to come off USDA's balance sheet for this all to balance. It'll be interesting to see how they treat that here in the next 2 weeks. Moving ahead, one of the positives is corn export sales, and I've been talking about this all winter. I went around the state and talking about how we would likely see a surge in export demand for corn in that February-March timeframe. We saw that. It probably became a lot bigger due to the low price nature of corn, people being able to buy cheap U.S. corn and stick it in stocks reserves. But we saw it. It did show up, and so I had that right. I just missed the effect that coronavirus was going to have on our global system. However, when we look, these are new sales per weekly sales of new sales. So these aren't just exports; these are commitments, basically. What has been sold that week that will be shipped at a later time. Traditionally, Mexico comes in and buys one big shipment in December. So we traditionally have Mexico buy, and they did this year as well. They bought their one big shipment in December. But the red bars here, we've seen a surge of sales lately. Again, cheap U.S. corn price, but it's also brought other players into the market as well. South Korea, Japan, India, China as well. They've been buying corn for the first time in several years. We also have this white buffalo, what I'm terming to be a white buffalo effect out there, from the standpoint of China has committed to buying 20 million metric tons of corn from the globe as a result of building domestic stockpiles of corn. That's a huge amount. And when we look at what China normally buys, they're usually somewhere below 2 to 3 million metric tons annually. They have a quota to where they basically are supposed to buy 7.2 million metric tons. They've already filled that for the year, and now they're committing to another 20 million metric tons. So in total, China would effectively this year, at least what they've told us as of April 23rd, go from buying about 2-3 million metric tons of corn a year to now buying 27, 28 million metric tons. The question is will that happen? When does it happen? Do they need it? Probably not. They probably don't need it. They're just strategically taking advantage of cheap corn. However, that would be a positive sign for the U.S. export picture, because when we look at global corn stocks around the world, and again, these are individual marketing years, and then the days I have represented atop the bars represents days of supply. So this is how many days we could go on the excess supply we have over our domestic use. The black bars represent the full world. So we have about 98 days of corn supply on hand right now, in excess of what we would need. Clearly, we've grown that substantially since 2013, 2014. We've continued to grow that. We started coming down from that a little bit. But when you take the United States and China out of the mix, you're left with these red bars. So this is everybody else across the globe. Again, if China is looking to buy corn from the world market, they're not going to buy it from themselves, right? They're going to buy it from somebody else. So we throw China out, and then we say, okay, let's take the U.S. out and look at the possibility of China buying from other places around the globe. Well, if we look at everybody else, we're at 34 days of corn supply globally. That's the tightest we've been on corn supplies globally, without the United States and China since 2001, 2002. So global supplies of corn are actually really tight. There's not a lot of room for error here, especially if Brazil has a shortened second crop corn production, which has been reduced the last 2 weeks due to drought in South America. We're seeing some dryness in Ukraine and Eastern Russia, limiting the availability of some of these stocks of corn in other countries not named the United States. So I think this makes the United States a very attractive player in the world market if China is going to go into the market and buy substantial amounts of corn. So that kind of plays into what this was here, right? Like I spoke all winter about the potential for U.S. corn exports to see a nice bump in February, March. It got delayed because of coronavirus, but they still came. And the question now becomes, will they continue? And I think there is possibility for them to continue, given this picture here, especially if we see any type of shortfall in South America. Let's talk about feed use real quick. Garth did a wonderful job talking about livestock. I just have some statistics that I pulled here. But the interesting case around corn feed use demand is when the packing plants are working appropriately, when there is no bottleneck at the packing level, and corn is cheaper today than what it was 3 weeks ago, we see a surge in corn feed use because it now becomes, there's an incentive for packing operations in Ohio, but especially out west, to feed more corn. It's cheaper on the input side, and they can add pounds at a higher rate of gain. And so therefore we feed more corn as long as those cattle are moving through the system. When we have this little bottleneck in O-ring, not only do we have effects on the livestock side, as what Garth mentioned, but it also slows down our corn consumption for feed drastically. We see a lot lower corn for feed demand. And so that's weighing on us, right? And this can be showcased in our cattle on feed. The April cattle on feed. So this is all the cattle that we have on, calves ready to go to slaughter, and then any cows or dairy that are on dry feedlots as well. And basically, if we look at cattle on feed, we were down 5% year over year, but it was our March placements that were really concerning. Our March placements, or new cattle on feed for the month of March, were down 23% year over year, and that's our lowest March placements since 1996. That follows a February placement rate that was also low, and I think we're going to see another really low, I'm estimating another really low April placements that'll come out here in the next week or so. So a lot less cattle going on to feed. That starts to shrink our potential for feed use later in the year. However, the counteracting factor is since we have no ethanol production or decreased ethanol production, there's been a strong decrease for dried distillers grains, which is what I'm trying to represent here. So down here in this bottom chart, this is the relative prices of corn to other feed stuff. And I'll just point out the blue line is dried distillers grains to corn. And you can see the increase of dried distillers grain price compared to corn, making corn more attractive as a feed source. So even though we have less cattle on feed, same way with pork, I could show the same examples on pork. The counter fact here is we have stronger competition for other feedstuffs due to decreased production of DDGs. Soybean meal, also a limiting factor as well. And so corn has become more attractive, and therefore we expect to feed more corn. And that's why I'm trying to estimate up here in this box. I've got it right now at a 69% use rate for the first half of the marketing year, which would translate to about 5.8 billion bushels of corn use. USDA is currently below that at almost 5.625 billion bushels. So I think there's 100 million, 75 million bushels of corn that could be added to the feed use, just given some of this competitive nature that we've seen of corn compared to other feedstuffs. When we look at our planting intentions across the country, so this is now how many acres of corn on the supply side we plan to produce. Nationally, it comes in almost 97 million acres of corn. That's our largest value of corn acres since 2012. So a lot of corn acres on hand when we look at Ohio and Michigan, this eastern corn belt region right here. 3.7 million acres of corn here in Ohio. That's 900,000 more than we produced last year, given 2019 was a rough year and we didn't get as much corn planted as what we had hoped to plant. We had a lot of prevent plant acres, but still an increase in corn supply here in the eastern corn belt, but then also nationally. So we're looking at a large acres of corn. This would imply almost 18 billion bushels of supply if we add in just the last year's carryover in terms of what we didn't use from the previous year. Almost 18 billion bushels of supply, which is a really large supply, and I'll show you those numbers together. When we look at crop progress, so this is now planting progress. Ohio's at 10% planted. I think this is higher than this. I would put it somewhere a lot. I would put it closer to 20% personally. I think there's a lot of people that would even put it higher than that. I know I've talked to several of our OSU people, and they would put it higher than that. But I think 10% is what USDA put out. So if we're comparing apples to apples, Iowa was at 78%, Minnesota was at 76%. So there's other places around the country that are being able to get in and plant corn. It's just really slow here in the Eastern Corn Belt. There is an incentive. So these are Ohio now contribution margins. So this is now looking at returns for corn versus returns for soybeans. And there is a $100 benefit to planting soybeans over corn. So the red bars represent an incentive to plant soybeans. The black bars represent an incentive to plant corn. This is as of the decision point. So if you're looking at market signals, and again, this is just market revenue, not taking into account any government programs or cost share. It's just revenue from the market, yield times price minus variable cost. And soybeans are highly preferred here in Ohio. In fact, this is our, if there was a year that the market was signaling to plant soybeans, it would be this year. And part of that is the decreased harvest basis. We've seen the decreased corn futures price, but we've lost 50 cents in our corn basis for new crop here in Ohio just in the last month, whereas we haven't seen that same hit on the soybean side. Soybean basis has held a lot firmer. And that's largely what's driving this wedge between soybeans and corn. However, this is a very messy slide, and I apologize for this. But basically now this is taking into account government programs. So the red bar across the top here represents dollars per acre guaranteed by either the market, crop insurance, or our government commodity programs, the Park County and PLC programs that a lot of you might be familiar with. The red bar across the top represents dollars per acre, and this is at 10-cent increments of price. So, the first dot here, market revenue at an average yield at a price of $3.90 is guaranteeing you $620 per acre with a 85% revenue insurance product. As you can see, the purple line represents market revenue. So as price falls, right, we're not assuming changes in yield, your market revenue decreases. But we start picking up government programs. The black line represents PLC program payments. The green dotted line represents the insurance coverage. And you can see that when you add the purple line and the black line and the green line together, it gets you this purple line here this red line that's increasing. I've only got 90 seconds left, so I'm going to go through this real quick. But basically, if you take into account government programs, by the time we get down to $3.10 of market price, we are now guaranteed or protecting revenue at $640 an acre versus our original baseline of $620. And that's kind of seen as like being between $330 and $310 is about our worst case scenario because we're below our baseline, but we're not exceeding that baseline. And so we just need prices to either recover above $330 or to continue to go lower. I know that sounds crazy. None of us want to think of that, but that's ultimately what this is telling. There's less risk protection at soybeans because the soybean declines all the way to $7.62. And so we're going to continue to see more risk of soybeans. So don't be surprised if we see 97 million acres of soybeans. And I found this on Twitter. I love graphics on Twitter sometimes, but coronavirus has really killed our feed demand and our ethanol. We've seen strong exports, but we're looking at 97 million acres of corn coming into the picture. So if we look at the balance sheet, here's my corn estimates for the current year, right here, 2019, 2020. Here's next year's crop. And basically I'm looking at an ending stocks of 3.4 billion bushels, a 24% stocks to use ratio, and a farm cash price of $2.90. That's cash price. So it is possible to see, lower prices moving forward. I have a couple.
Right. Welcome back, everyone. A few assignments to make. Emily or Amanda,
Kate.
any announcements? Oops, sorry.
Well, I was just gonna say, I didn't see a poll button in the breakout rooms, so we could do that real quick. Kate and Melinda, if you're okay with that. The people who were gonna do the food preservation one, well, this poll right now, if you guys can answer it. You guys see it? Okay, good.
Amanda and Jared, I'll also need co-host abilities in order to record.
Is that Aaron?
Yep.
Yes.
I meant to do that right before I assigned you last round, and then I missed you.
Jared, this is Kate. Same here
I think
for Melinda and I.
I think you and Melinda both should have it,
Okay.
and Tim, you should also.
Okay, so I'm just gonna share this so you guys can see the responses to the poll.
And Melinda and Kate, I am emailing you a screenshot of that just in case you need to reference it later.
All right.
Hey.
Thank you.
Ben, it looks like you might still be recording if you want to hit stop.